Mark, we talk a lot about weakness in the dollar, and weakness in the dollar continues to be a feature this morning. We've seen moves into the yen, of course, overnight. The euro a little bit stronger on the back of that. This to do with the latest trade headlines. How much further do you think euro strength has to go?
So two time spans. One is there's the longer term story where I think that euro dollar is going to go an awful lot higher. As I always say in this program, 130 before 106 is my updated kind of metrics. That story is about diversification away from the dollar. Again, it's not about an abandonment of the dollar. It's just about reducing exposure. Dollar will remain the world's reserve currency, but euro is like one of the most viable alternatives if you want to increase your diversification. It's not about a particularly aggressive euro story. There is a positive euro story in isolation from the dollar, but it's not enough to drive it that far. This will be an overshoot from euro terms and might cause the continent some problems, but it's going to happen because of dollar weakness. In the shorter term, I don't really have any particular conviction, but my view is that the dollar has been depreciating for the last 5-6 months. And until at some point there's going to be a material squeeze, a short squeeze, it'll only be a temporary one because the structural trade is true. But until we start seeing signs of that squeeze, I don't know why you'd get bullish. So, you know, the structural trade is short dollar. You've got to be bearish dollar until you've got a reason for a squeeze. I don't see it on the horizon just yet.
Talk to us a little bit about the disconnect, perhaps, with what we're seeing from the bond market versus the currency markets. Mark, I'm looking at a range here, basically, of 420 to 460 on the U.S. 10-year, despite the fact that the dollar continues to weaken. When does the bond market and the FX market start to move in tandem again?
Yeah, I think that, look, the dollar trade has many different tangents to it. The world's overexposed to U.S. stocks. They significantly want to reduce that over time. They also have exposure to the US that's unhedged. They bought it because of the dollar smile. So when there was risk-averse periods, people went back to the dollar. That's now changing a little bit. In fact, my colleagues in New York have referred to it as a dollar frown recently, which may only be temporary. But the fact is, there are people, even if they're keeping their dollar US exposure to assets, then they want to hedge that a little bit more on the currency side. And then finally, there's the treasuries trade. And again, there's no reason to panic about US treasuries in the short term, even if you're quite worried about the direction over the next couple of years, like I am. Short term, there's absolutely no reason to get bearish right now, which is why I think that all these trades work at different time spans. But overall, the dollar trade remains very strong. And the disconnect is not alarming at all between treasuries and the dollar just now.
OK, and Mark, what did you make of the inflation print we got out of the United States yesterday, waiting for data to break in one direction or another, and we seem to keep on waiting?
Yeah, I think probably the main takeaway is that this might be the tariff impact for now might be more of a growth impact than an inflation impact. We saw deflationary in some of the services components outweigh what we've seen in goods components, which is quite interesting. What it also says is companies are absorbing the cost. So that's not great for shares. So I think ultimately the biggest takeaway from this CPI print is probably negative for stocks, even though we haven't seen that play out yet.